China's $42 trillion crisis is shaking the world. For decades, China's economic miracle dazzled the globe. Hundreds of millions lifted from poverty, cities rising overnight. But beneath the surface, debt and overreach have pushed the economy to a breaking point. Trillions have vanished from the real estate market, local governments are drowning in hidden liabilities, and millions of Chinese citizens face shattered dreams. This isn't just China's problem, it's a global risk. The question isn't if the crisis will hit, but how deep the fallout will be. Let's pull back the curtain on China's $42 trillion crisis. Real estate was China's economic engine, nearly 30% of GDP, a symbol of prosperity. Families invested everything, believing property values would always rise. Developers, fueled by easy credit, built at a breakneck pace, entire cities often with little demand, but it was all built on debt. The collapse began with Evergrande, $300 billion in liabilities, followed by Country Garden and a wave of bankruptcies. Construction halted on millions of pre-sold apartments, leaving families with mortgages on homes that may never be finished. The trust that fueled the market evaporated, buyers vanished. The loss? An estimated $42 trillion in property value, life savings wiped out for a generation. The middle class, once the backbone of China's rise, is now facing ruin. Consumer confidence has plummeted, chilling the entire economy. This isn't just about empty apartments, it's a breakdown of the social contract. The government promised prosperity through property. Now that promise is broken. Beijing is trapped, unable to reignite the real estate engine or allow a total collapse. The ripple effects are massive. Construction, steel, cement, all in deep decline. Millions of jobs are at risk. The property crisis is a wildfire, threatening to engulf the entire economy. What once drove growth is now a dead weight. The Great Wall of Debt is crumbling. China's real estate miracle has become its greatest liability. The fallout is just beginning. While developers collapsed, another crisis brewed: local government debt. To hit growth targets, officials borrowed massively through shadowy local government financing vehicles, or LGFVs. Trillions were spent on infrastructure, subways, airports, highways, often with little economic return. The system depended on land sales to developers, but with real estate in freefall, that revenue has vanished. Now cities are drowning in hidden debt. Estimates range from $7 to $13 trillion. Many are effectively insolvent, slashing public services, cutting salaries, and even turning off streetlights to save money. This austerity is choking local economies, creating a vicious cycle of decline. Unfinished projects litter the landscape, symbols of wasted investment and mounting debt. Beijing faces a dilemma: bail out local governments and risk moral hazard, or let them default and trigger a financial crisis. For now, the central government is patching holes, but the debt bomb is still ticking. The infrastructure that once symbolized progress is now a liability. The grassroots economy is suffocating. China's hidden debt crisis is far from over. The consequences are only beginning to surface. Europe was once a goldmine for Chinese exports: electronics, cars, solar panels. But now, Europe is pushing back, accusing China of unfair trade practices and massive state subsidies. The EU is investigating Chinese electric vehicles, likely leading to steep tariffs and a new trade war. Europe is also tightening investment rules and screening Chinese state-owned enterprises. The message unfettered access to Europe is over. This is part of a broader de-risking strategy. Europe wants to cut its dependency on China for critical goods. Supply chains are shifting, and Chinese exports to the EU are already falling. European companies are pulling back, spooked by political tensions and China's slowing economy. The golden age of Sino-European trade is ending. For China, this comes at the worst time. Domestic demand is weak, and exports are faltering. With both the US and Europe closing ranks, China faces growing isolation. The export engine that once powered growth is sputtering. The walls are closing in. China's global ambitions are under threat. The trade war is just beginning. Beijing's dream was to turn China into a tech superpower: AI, semiconductors, biotech. Billions were poured into research, universities, and state-backed giants like Huawei. For a while it worked. China led in 5G, AI, and space exploration. But the economic crisis is forcing painful cuts. Funding for universities and research is drying up, projects are delayed, hiring has stalled. The semiconductor sector, already battered by US sanctions, is struggling. High-profile chip companies have failed, burning billions. Tech giants like Alibaba and Tencent are laying off staff. The optimism that once defined China's tech sector has vanished. Without massive investment, China risks falling behind in the global tech race. The strategy to escape the middle-income trap is faltering. The CCP's legitimacy is tied to tech and prosperity. Both are now at risk. The dream of tech self-reliance is slipping away. China's tech ambitions face their toughest test yet. China faces a cascade of crises: property collapse, hidden debt, trade wars, and a tech slowdown. The debt-driven growth model is breaking down. The middle class is shaken, youth unemployment is soaring, and foreign investment is fleeing. Old partners are closing doors, and the tech dream is running out of fuel. If these issues remain unresolved, China could face its biggest crisis since the 1970s. The world will feel the shockwaves. The era of China as the world's unstoppable growth engine is over. What comes next is uncertain.